Silver just shattered everything we thought we knew about precious metals markets. And I'm not talking about another routine price spike. I'm talking about a complete system failure unfolding right now in real time. While central banks and exchanges are scrambling to contain something they can no longer control, Shanghai just pulled the emergency brake, hiking margins to unprecedented levels over the weekend in a move that screams pure panic. And here's the problem. It's not going to work. In fact, it may make everything worse. Let's begin with the numbers the market can no longer dismiss. Silver hasn't just pushed higher, it has erased a ceiling that held for 4 decades. Prices are now moving in a band between $61 and $64 an ounce. And on December 12th, silver briefly surged to $64.65, setting a brand new historic peak. To understand why this matters, you have to look backward. The previous record was set in 1980, near $49 an ounce. That level stood untouched for 45 years. Nearly half a century of resistance, wiped out in a matter of months. Since the start of 2025, silver has climbed more than 115%. This isn't the steady rise of a healthy bull market. This is acceleration. This is the kind of price behavior that shows up when underlying systems begin to fracture. Gold has performed exceptionally well, gaining roughly 60% year to date. But silver isn't just outperforming, it's pulling away entirely. The gold-to-silver ratio, a long-used measure of relative value, has collapsed from above 90 to roughly 67. That shift signals a dramatic repricing of silver relative to gold, and it's a warning sign that something deeper is changing beneath the surface. But here's what matters most. The surge in price isn't the headline. What happened away from the charts is. This brings us to what I call the Shanghai alarm. One of the most unmistakable displays of institutional fear seen in modern commodity trading. Imagine the timing. It's late Friday night. The trading week is over. Markets are shut. Activity is supposed to slow to a crawl as traders step away. Then the Shanghai Futures Exchange makes its move. Without warning, it raises margin requirements on its primary silver futures contract to 17% for speculative positions. If futures markets aren't your world, here's why that matters. Margin functions as a performance bond. Capital traders must post to prove they can withstand adverse moves. When an exchange increases margin, it dramatically raises the cost of staying in the trade. The intent is to reduce leverage, flush out weaker positions, and slow the market down. Now consider the context most people miss. Typical commodity margins usually sit in the 5% to 10% range. Shanghai was already demanding 16% before this announcement. That level alone signals deep concern about volatility and settlement risk. And still, they went further. They pushed margins to 17%, announced after the close over the weekend. That detail matters. Exchanges don't act this quickly or this forcefully unless they believe control is slipping. This wasn't a measured policy change rolled out with advance notice and justification. It was reactive. It was urgent. They were watching prices accelerate. They were seeing delivery requests stack up. They were watching physical demand overpower paper supply. And in that moment, they understood how close they were to the edge. At this point, a fair question comes up. Why does Shanghai matter more than New York? Why should the actions of the Shanghai Futures Exchange carry more weight than what happens on the COMEX? That question sits at the center of everything unfolding right now, because these two exchanges don't play the same role. Think of the COMEX as the paper arena. It's a financial marketplace built on leverage, speculation, and price exposure. Enormous volumes of silver contracts change hands every day, with no expectation that metal will ever move. Prices are discovered there, yes, but they're discovered in a world largely disconnected from physical supply. Most contracts never result in delivery. They're settled in cash. Shanghai operates in a completely different universe. The Shanghai Futures Exchange is tied directly to the physical economy. It's where manufacturers secure real silver to keep real production lines running. Chinese companies can't assemble solar panels or electric vehicles with digital promises. They require metal, in hand, on schedule. And China's demand for silver is anything but small. China stands as the largest consumer of silver on the planet. It leads global solar deployment, with more than 200 gigawatts of new capacity planned for 2025 alone, a build-out that consumes massive quantities of silver. At the same time, electric vehicle manufacturing is accelerating. Each EV requires substantially more silver than a traditional car, roughly 25 to 50 grams, compared to about 15 grams in conventional vehicles. When production reaches the millions, that difference becomes enormous. For these advanced industrial uses, silver isn't optional. There is no equivalent substitute that delivers the same electrical performance. Silver's conductivity is unmatched. It's not interchangeable. It's mission critical. And Chinese industry understands this reality better than anyone because they operate these factories at scale every day. So when the exchange serving the world's largest physical buyer is forced to hit the emergency brakes, this isn't a regional issue. It's a global warning. It's a distress signal sent from the core of industrial demand, telling the world that the physical silver market is under serious strain. Let's examine what Shanghai hopes to achieve with this sudden margin hike. The plan is simple, on paper. By dramatically raising the cost of holding long positions, bets on rising prices, the exchange intends to force liquidations. The goal: flood the market with paper supply, push prices down and regain control. This is a classic tactic in paper markets. Experienced traders saw it coming immediately. Within minutes of the news spreading, warnings exploded across trading communities. Prepare for chaotic opens. Brace for heavy swings. This is a deliberate shakeout. But here's the critical problem, and why this effort may fail. Paper prices can be manipulated. Margins can be increased. Trading can be paused. But physical silver cannot be conjured out of thin air. Factories in China don't stop operations because an exchange changes rules. Solar panel makers still have delivery commitments. EV factories still have production quotas. Electronics firms still need components. The demand is real, immediate, and non-negotiable. This is the exact paper versus physical divide analysts have been warning about for years. According to the Silver Institute, the global silver market is projected to run a fifth consecutive annual deficit in 2025, about 117 million ounces, more than 3,600 metric tons. Mining output remains stuck near 813 million ounces, while demand continues to grow. Industrial usage hit a record 680.5 million ounces in 2024, and is expected to surpass 700 million ounces in 2025. Solar alone is projected to consume 261 million ounces, with electric vehicles adding another 90 million ounces, not counting electronics, medical devices, and other industrial needs. Here's why the intervention can backfire. When paper prices fall, physical buyers rush in. Manufacturers accelerate purchases. Investors take advantage of lower prices. Instead of relieving pressure, these measures often increase physical demand. The result? Rising premiums on physical silver, wider gaps between market quotes and real-world delivery costs, and escalating stress on exchange inventories. In the short term, expect wild swings, more margin hikes, circuit breakers, and possibly trading halts. But every emergency step sends the same message. The system is losing control. Over the medium term, physical premiums continue to climb. Delivery delays stretch out, paper and physical prices diverge further. Long term, if supply remains constrained and industrial demand grows, prices once considered extreme, $75, $100 or higher, become entirely plausible. The unavoidable question: how high can silver climb when manufacturers, investors and institutions are all competing for a supply that cannot be expanded on demand? We've already surpassed the 45-year high. The market is now operating in uncharted territory. The takeaway is clear: the silver market is under stress. Shanghai's margin hike confirms it. Paper tools cannot override physical limits. Supply shortages are structural. Demand is relentless. This isn't financial advice. It's an observation of a system under pressure. The repricing of silver is not coming. It's happening now. And no matter how many emergency measures follow, the physics of supply and demand will always prevail. The story is far from over.